You ever feel like you've got the medicine part down, but the business side of your veterinary practice feels like a constant uphill climb? You're not alone. Most vets never got training in finances or practice management, and that's exactly why I started this weekly series. I'm Cassie Sykes, enrolled agent and founder of Greener Pastures Income Tax. Every week, I go live to take the guesswork out of veterinary business finances so you can lead your clinic with more clarity, confidence, and profit. Why do I offer this for free? Because when vet practices are financially strong, everybody wins. You, as the owner, your incredible team, and most importantly, the animals you care for. These Facebook lives help me too. They keep me connected to this amazing community and focused on what really matters, taking your life a little easier, one strategy at a time. If you're ready to feel more in control of your numbers and finally ditch the overwhelm, you're in the right place. Tag a DVM who'd benefit and hit share. We're diving in now. Give me 1 second to share. Stop. So, hi again, everyone, and welcome to this week's live. If this is your first time here, welcome. I work with veterinary professionals across the country to simplify the financial side of practice ownership. Whether you're a solo mobile vet, uh, running a multi-location clinic or somewhere in between. Today, we're diving into a topic that most practice owners either overlook or aren't fully optimizing: vehicle and mileage deductions. If you're not sure you're handling it the right way or you suspect you might be missing out on savings, this one's for you. Just so you know who you're learning from, I'm Cassie Sykes again. I've spent the last 25 plus years helping veterinarians understand their numbers and build financially strong businesses. I live here in East Texas with my husband and 2 teenagers, and outside of work, I skate roller derby under the name Can't Tax This, number 415. Yes, that's a tax deadline joke, and yes, I fully own it. What lights me up is helping practice owners feel less stressed and more empowered when it comes to their finances. You've worked too hard to stay stuck in the weeds or hand everything off blindly. So let's dig in and get you the clarity you deserve. Let's get started. Now, you've probably heard that using your car for business means you can write off some expenses. That's technically true, but it's also a topic that's full of misunderstandings, assumptions, and unfortunately mistakes that can cost you a lot of tax time. Either you miss out on deductions you could be taking, or you claim things you shouldn't, and both can hurt your bottom line. So today I want to talk or walk you through exactly how this deduction works, what qualifies, how to track things the right way, what the IRS actually looks for, and how to decide which method is going to give you the biggest legal tax savings. This isn't just about riding off gas or getting a break for driving to a CE event. It's about making strategic decisions that can help save you thousands a year with very little extra effort. So let's start with the basics. When can you deduct vehicle expenses? If you're using a vehicle for business, and I mean legitimate business use, the IRS allows you to deduct the cost of that use using one of two methods: the standard mileage method or the actual expense method. You get to choose which one to use, but you can't switch back and forth on the same vehicle in the same year, and you definitely can't claim both. This is a big area where people get tripped up. Let me give you an example. Let's say you own a practice and you use your personal SUV to make weekly runs to the pharmacy, drive to another location once a month, and travel to a couple of continuing education conferences a year. All of that mileage, assuming it's for business purposes, can be deductible. But the way you calculate that deduction depends on which method you choose. So let's break each one down. With the standard mileage method, you don't have to worry about tracking fuel, repairs, or insurance. You just need to track your business miles. That's it. The IRS gives you a set rate per mile. For 2025, it's currently 70 cents, and you multiply that rate by the number of business miles you drove during the year. So if you drive 6,000 business miles, that's a $4,200 deduction. But, and this is where people mess up, you have to have a mileage log. The IRS doesn't accept guesses, averages, or end of year estimates. You need to show where you went, when, and why it was business related. Even something as simple as a calendar or a mileage tracking app like MileIQ or TripLog can work. It doesn't need to be fancy, it just needs to be accurate and consistent. Now, the actual expense method is more detailed. Um, Instead of tracking miles, you track every dollar you spend on your vehicle. Fuel maintenance, oil changes, tires, insurance, registration, and yes, even depreciation. You total all of those expenses for the year and then deduct a percentage based on how much you use the vehicle for business. So if 70% of your driving was business related, you can deduct 70% of those total costs. This method can often result in a bigger deduction if your vehicle is expensive to maintain or if you don't drive a ton of business miles but spend a lot on fuel and repairs. It also requires a lot more record keeping. You'll need to keep receipts, tally expenses by category, and still track your total miles for the year so we can calculate that business use percentage accurately. So which one is better? There's really no one size fits all answer. If you have a newer fuel efficient vehicle and drive a lot for business, the standard mileage method is usually more beneficial and definitely simpler. If you drive a heavy duty truck, SUV, or older vehicle that racks up maintenance and fuel costs and you don't drive quite as often, actual expenses could give you a bigger deduction. And here's a tip. The standard mileage method is only available if you choose it the first year the vehicle is used for business. So if you're thinking of buying a new vehicle this year, we need to talk before you start using it for work because your choice can lock you into a long-term strategy. Now let's bust a myth that gets people into trouble. Commuting does not count. Driving from your house to the vet clinic every day, that's personal use. Even if you own the practice, that drive is considered commuting, which is not business related and it's not deductible. I see this a lot with practice owners who think, well, it's my business, so everything counts. And that's not true. What does count? Driving from your clinic to the feed store, driving to drop off lab samples, driving to another clinic you own or manage, driving to the bank for a business deposit, driving to a continuing education course or a conference, driving to meet your accountant or tax advisor. Yes, that's deductible. But the key is that it has to be a trip you wouldn't make if it weren't for the business. That's the IRS standard. Another common area of confusion is around buying or leasing a new vehicle. If you're planning to buy a vehicle in 2025 and use it primarily for business, you may qualify for a special type of deduction under Section 179 or bonus depreciation. These deductions allow you to deduct a large portion, sometimes even all, of the cost of the vehicle in the year you place it in service. But again, this only applies if the vehicle is used more than 50% for business, and you have to have documentation to back that up. And if you switch from business to personal use later, you may have to recapture some of that deduction, meaning you pay taxes on part of it later. That's why it's so important to plan this before you make the purchase, not after. Here's one last thing to think about: business versus personal ownership. If the vehicle is in your personal name, but you're using it for business, that's perfectly fine. You can still claim mileage or a portion of actual expenses. But if the vehicle is owned by the business, like titled to your S Corp or LLC, you can't just drive it for personal use whenever you want. That would count as fringe benefits and need to be included in your W-2 wages or tracked separately. For most of you, keeping the vehicle in your personal name and reimbursing yourself or deducting mileage is a lot cleaner. So let's recap what to do next. If you're not already tracking your mileage, start now. Open the Notes app on your phone and jot down every business trip this week. Start a spreadsheet. Download a mileage app. Don't wait until December. The earlier you start, the more accurate your records will be. If you're wondering whether the actual expense method might save you more this year, start saving receipts for fuel, maintenance, and insurance. You don't need to decide today. We can run both scenarios at year end and choose the better one, but only if we have the data. And if you're considering buying a new vehicle this year, talk to me first. We'll look at your projected income, your expected business use, and figure out whether Section 179 or bonus depreciation applies. and how to make sure you're in compliance. I know this topic feels dry, but let me be clear. Mileage and vehicle deductions are one of the most powerful tools available to small business owners. Used correctly, they can shave thousands off your tax bill. But used carelessly, they can cause problems. Let's not guess, let's be strategic. If today's topic about vehicle and mileage deductions left you wondering whether you've been tracking things correctly or how much you might be leaving on the table, you're not alone. Not alone. Most practice owners I talk to aren't sure what qualifies, how to document it, or whether they're truly maximizing the deduction. That's exactly why I offer the profit and cash flow analysis. It's not just a generic report, it's a personalized conversation where we take a closer look at what's happening in your practice financially, including how vehicle use fits into the bigger picture. We'll identify what's working, where there might be gaps, and whether a full diagnostic makes sense. If so, I'll build a custom proposal around exactly what your clinic needs. This is about more than mileage. It's about clarity, confidence, and making sure no money gets left on the table. You can book that free analysis at the link that I'll post below. Before you go, I want to share an incredible resource designed to elevate your veterinary practice's financial success. I put together a free ebook just for you called 7 Financial Strategies. Inside it, you'll discover practical steps to increase profitability, improve cash flow, and make smarter financial decisions for your practice. You can grab your free copy in the comments. Thank you so much for tuning in today. If you found this helpful, like this video, share it with other veterinarians, and I'll see you next time when we talk about how to streamline pet insurance coordination. I hope you have a great rest of the week and talk to you soon.